I do think Wall Street can create jobs, and I think Wall Street, can advance the good of the commonweal if it is constrained and incentivized by public policy. And I think that the problem with the last 30 years is that regulators, along with everybody else, thought that they were the smartest guys in the room and they could police themselves. And there's the kind of famous quote by Alan Greenspan saying, admitting like there was a big flaw in my ideology, like I was wrong about this. I didn't think people would behave in this sort of way, in these sort of self-defeating and society-defeating ways, and they did. But I've talked a lot about inequality. I would also just say, add to that in terms of recurring themes in financial crises and financial booms and busts. The other thing to really worry about and to look at, because you see it time and time again, Robert already mentioned it, is leverage. And I'd imagine that everyone in the room is probably already familiar with the role of retail credit, credit to investors and homeowners, the role that kind of borrowing plays in fueling asset bubbles. So you can think about trading on margin in the 1920s to gamble in the stock market, the no down payment, interest only second mortgages to subprime borrowers extended between sort of 2000 and 2007, and that's gets a lot of press and gets a lot of attention. But I think what's less well known and less widely discussed is the role that leverage within the financial sector, leverage taken on by financial institutions, plays in these booms and busts.